Okay, let's unpack this. We're doing a deep dive today into a man whose career arc looks less like a trajectory and more like a seismograph chart.
That's a perfect analogy.
Right. It's measuring the highest highs and the absolute lowest lows of global finance. We're talking about Masayoshi Son, the founder, chairman, and CEO of SoftBank Group.
That seismograph analogy is exactly right. I mean, when you look at the sheer scale of his decisions, his career just defies any traditional understanding of risk management.
Mm.
Our mission today is to take all these sources you've pulled together, detailing his entire life, from his youth in Japan to his current global position, and really try to understand the anatomy of the ultimate risk taker.
Yeah.
And this isn't just a study in success, it's an examination of how colossal, world-breaking losses and revolutionary wins can, define an entrepreneur's character.
The central tension in his story is just immediate
Yeah.
and honestly astonishing. On one hand, you have this globally recognized entrepreneur, a philanthropist who achieved massive success in pretty much every sector he touched.
PC software, publishing, telecom.
Exactly. He remains a titan today. He's sitting at number 65 on Forbes' list of the world's billionaires as of May 2025.
But here is the massive, almost unbelievable counterpoint that I think underpins his entire philosophy.
Okay.
For many, many years, Masayoshi Son held the distinction nobody else wanted. He was the person who had lost the most money in history.
And we're talking about a staggering amount.
A staggering financial annihilation. A loss of more than $59 billion suffered during the 2000 dot-com crash alone, when SoftBank shares just completely cratered.
To put that in perspective for you, that figure, 59 billion lost in a single downturn, was the global standard for financial disaster for nearly 2 decades.
Right, it was the benchmark for failure.
It was, yeah. It was only recently surpassed by Elon Musk's recent market fluctuations. Yet, what really stands out is his absolute refusal to stay down.
Exactly. He is defined by this continuous high-stakes adaptation. I mean, look at his modern recognition. Just in 2024, he was included in Time's 100 most influential people in AI list.
Which is incredible after the Vision Fund disaster.
It's a testament to his ability to survive a world-changing financial collapse, pivot the entire focus of his business, not once, but twice, and still emerge as a visionary in the newest, most critical technology field.
And his titles today really reflect this multifaceted, adaptive reality. He's still the chairman and CEO of SoftBank Group, the investment holding company. Crucially, he is the chairman of Arm Holdings, the fundamental UK chip designer.
The plumbing of the entire mobile industry.
Totally. And now he's assumed the chairmanship of Stargate LLC, which is a major new AI infrastructure joint venture. So to understand this extreme high-leverage risk appetite that connects all these disparate roles, from telecom to chips to massive AI infrastructure, we have to start at the beginning.
Yeah, we have to.
With the foundational pressure of his earliest years.
We need to trace this back to his birth in 1957. He was born Masayoshi Yasumoto in Tosu, Saga Prefecture, Japan. But the sources all emphasize that his foundational identity was shaped by being Zainichi Korean.
And that context is so much more than just biographical color, isn't it?
Oh, it's everything. You could argue it's the source code for his personality and his entire risk-taking philosophy.
And for anyone listening who might be unfamiliar, these Zainichi Korean population historically faced significant institutional and social discrimination within Japan, even after multiple generations living there. How did that specifically shape his family's experience?
It created an environment of just constant vulnerability. It required them to operate outside of established norms just to survive. His grandfather, Sun Chung-kyung, was a native of Daegu who moved to Japan and worked as a miner.
So already an outsider.
Total outsiders in a very traditional, homogenous society. And his father, son Sam Hyun, further defined this environment. He began by raising animals, but then, and this is critical, he illegally built the family home on land owned by the Japanese National Railways.
Wow. Okay, so that sounds like a constant low-grade conflict with authority right from the start, defining success by bending the rules.
Precisely. That unauthorized housing, it led to predictable troubles with the authorities, constantly being under threat. However, his father also showed this early, successful entrepreneurial spirit by starting an illegal sake business.
An illegal sake business.
Yes. And the key detail here is that the business became successful enough for the family to be the first in their entire town to own a car.
So Masayoshi Son's earliest environment taught him a really powerful lesson.
A very powerful lesson. Success particularly rapid and meaningful success, often requires operating outside the established rules and assuming extreme personal and legal risk.
And this precarious status must have profoundly impacted his identity, especially when it came to his name.
It did, absolutely. The family initially refrained from using their Korean names, instead using the Japanese name Yasumoto. They were trying to assimilate and avoid prejudice.
But it didn't work.
No, the discrimination was still severe. The sources note that Son experienced bullying to the point where he actually contemplated suicide.
That is an immense formative pressure for a child.
Immense. He was constantly struggling for acceptance, for validation, in a society that viewed him as an outsider. This psychological backdrop, it creates a person who is constantly driven to prove himself through just unprecedented achievement.
This intense internal pressure then leads directly to the first major turning point we have to talk about. The pivotal, very high-effort meeting with Den Fujita.
Ah, yes. The founder of McDonald's Japan, whom Son deeply idolized.
Tell us that story.
This story just defines his relentless, almost fanatical pursuit of a goal. Son made multiple failed attempts to contact Fujita, where most people would have given up after the first, maybe second refusal.
Sure.
Son didn't stop. He bought a plane ticket to Tokyo, flew there, and just showed up unsolicited at the headquarters of McDonald's Japan, demanding an audience.
He literally bypassed the bureaucracy of the entire corporate structure just to get in the room. What did he get for that boldness?
He secured a 15-minute conversation with Fujita, and that short window fundamentally redirected his entire life.
What was the advice?
Fujita advised him to study 3 things: English, computer science, and most importantly, he told him to move to the United States for his education. This was the moment Son decided to break away from the conservative, tradition-bound educational path expected of him in Japan.
And he didn't just follow the advice, he executed it with, frankly, frightening speed. He drops out of Japanese high school at age 16 and moves straight to Oakland, California.
The velocity of his adjustment is just incredible. He studied English at Holy Names College, and then, rather than spending 4 years in high school, he graduated from Saramonte High School in just 3 weeks.
3 weeks?
3 weeks. This just shows a phenomenal commitment to accelerated learning and a willingness to bypass the standard time frames imposed on everyone else. He then went on to the University of California, Berkeley, graduating in 1980 with a degree in economics.
But the truly fascinating part, for me, is that his entrepreneurial model, the high leverage, the high risk, the global perspective, it was fully formed while he was still a student at Berkeley. This was the prototype phase for SoftBank.
It was pure, high-stakes hustling right out of the gate.
Right.
Take the electronic translator. He didn't just conceive of it. He collaborated with professors, including Forrest Moser, to actually develop it.
Mm-hmm.
And the risk wasn't just in development, it was in sales. He sold the patent to Sharp Corporation for a stunning $1.7 million.
While still a college student.
It was a student.
$1.7 million in 1980 is roughly equivalent to $6.3 billion today. That is an immense windfall for a student, far more than most college graduates earn in their first decade.
And he didn't put it in the bank.
Yeah.
He immediately leveraged that success into his next venture, demonstrating the high-debt, high-reward model we'd see later with SoftBank.
What was that?
He made another $1.5 million importing used video game machines from Japan. And crucially, he did this on credit.
High leverage.
Pure high leverage. And he installed them in dormitories and local restaurants, focusing on rapid cash flow and scaling in a novel high-tech sector.
So the DNA of the multi-billion-dollar vision fund, the rapid scaling, the heavy debt, capitalizing on technological novelty, it was being tested with video games and electronic translators decades earlier.
Absolutely. He was perfecting his model, find a disruptive niche, apply maximum financial leverage, execute with extreme speed, and monetize immediately. He also started a video game company called Unison World in Oakland, which he sold to an associate for $2 million.
So by the time he returns to Japan in 1980, he's already a proven, self-made multimillionaire with a global technological view.
Correct.
And upon his return, he makes that powerful defining statement about his identity that we mentioned earlier. He chose to professionally adopt his Korean surname, Son, instead of the Japanese Yasumoto.
Even though his own family was against it.
Despite that opposition, why was that so significant?
This was a deeply personal and professional act of defiance. The source notes the opposition from relatives who feared the exposure and the prejudice it would invite. Yet, Son chose the path of visibility and pride. It wasn't just a name change. It was a refusal to assimilate fully, an insistence on defining his own success on his own terms.
And by doing this, the sources credit him with becoming a vital role model.
Yes. For ethnic Korean children in Japan who are struggling with bigotry, Son's very public success under his true name provided this undeniable example of defiance against social barriers. It just underscores that his business aggressiveness is entirely intertwined with his personal drive to validate his identity,
It's all connected.
all connected to the early choices he made to leave Japan and then return as a success.
Okay, so with that foundation set, he officially establishes SoftBank in 1981. It started humbly enough, right? Focusing on software distribution and publishing computer-related literature.
Yeah, that provided reliable early cash flow. And that initial cash flow was critical. Son immediately showed his knack for predicting market shifts, transitioning from simple distribution to investing in the burgeoning personal computing and internet sectors.
And SoftBank just boomed.
It rapidly expanded throughout the 90s, focusing heavily on technology and telecommunications.
His early tech investments are now legendary, and they set the stage for everything that came later. He bought a share of Yahoo in 1995, recognizing the dawn of the internet age. But the single most consequential decision of his career,
The anchor.
the anchor that would save the company later, was the Alibaba bet.
The Alibaba bet is the foundational success story of the entire SoftBank saga. In 1999, maybe early 2000, Sun made a truly visionary investment, $20 million into Alibaba Group,
A young Chinese startup at the time.
a young Chinese startup founded by Jack Ma. It was a massive high-risk bet on an emerging market and a totally unproven platform. And he did it just as the global tech market was about to implode.
And briefly, right at the peak of that irrational exuberance, the market gave him the ultimate reward for that risk.
Yes. For a fleeting period around February 2000, the rising valuation of SoftBank's tech holdings propelled Masayoshi Son to become, briefly, the richest person in the world.
Wow.
He stood at the absolute pinnacle of the dot-com revolution, celebrated as the ultimate internet oracle.
But the system couldn't sustain it. The 2000 dot-com crash hit, and SoftBank was directly in the epicenter, completely exposed by the very high valuations that had briefly made him a king.
The collapse was brutal and historic. The source material confirms that 2000 crash resulted in a loss of more than $59 billion for Sun. His SoftBank shares plummeted by over 98% from their peak valuation.
It's hard to even wrap your head around that.
You can't overstate the psychological and financial devastation this represented. He went from the world's wealthiest individual to the person who had lost the most money in recorded history, and he had to fight tooth and nail just to keep the company solvent.
And the company was struggling under the weight of all that debt, essentially fighting for its survival. How bad was the balance sheet in the immediate post-crash environment?
SoftBank accumulated about $1.3 billion in debt immediately following the crash. This financial pressure forced a radical existential pivot for SoftBank Corp., the operational arm of the business.
So they had to get back to basics.
They had to transition from a speculative investment model back to one focused on generating stable, predictable cash flow to service that massive debt.
So how did he manage that recovery? It required more than just cutting costs. It demanded a decisive operational strategic shift into a totally different sector.
He turned SoftBank Corp. Into an aggressive operational powerhouse in the telecom sector, challenging the established Japanese giants. In September 2001, he established Yahoo, broadband, leveraging his controlling interest in Yahoo Japan.
And he didn't just build new service.
No, he immediately went after scale.
That's where the acquisition of Japan Telecom comes in.
Right. Exactly. Yahoo. BB acquired Japan Telecom, which was at the time the country's third largest broadband and landline provider. This was a huge consolidation move. He used this infrastructure and market position to engage in ferocious price wars, driving down the cost of broadband access across Japan.
An aggressive market dominance strategy.
Which paid off tremendously.
And the result of that operational fight.
Yahoo. BB eventually became Japan's leading broadband provider. It generated the stable, reliable, massive cash flows necessary to service the $1.3 billion debt and stabilize the larger SoftBank Group.
That's the key takeaway, I think.
It's a huge contrast. The company was saved not by visionary internet bets, which were basically dormant in value at the time, but by grinding highly efficient operational dominance in the mature telecom market.
It's a stunning two-part story of survival. He takes a $59 billion loss, pivots to aggressively consolidate the telecom market to generate cash, and survives, all while holding on to that relatively tiny $20 million investment in Alibaba.
That is the crucial strategic lesson. Son knew that the Alibaba holding, though severely undervalued in the immediate aftermath of the crash, represented an eventual payout of unimaginable scale. The telecom business was the operational shield and the debt servicing machine that protected that long-term, visionary internet asset until the market finally caught up.
Okay, so moving into the 2010s, we see the spectacular validation of that early patience. The Alibaba bet transformed SoftBank from a powerful regional player into a global investment behemoth.
And it gives Son the financial firepower he needs for his next set of colossal moves.
The growth of that initial stake is just hard to comprehend.
It really is. The $20 million investment, plus some later stock purchases, reached a valuation of around $75 billion by 2014, following Alibaba's landmark IPO.
And it didn't stop there.
By 2018, SoftBank's 27% stake was valued at an incredible $132 billion. It single-handedly created the capital base necessary for the Vision Fund. I mean, it stands as perhaps the most successful venture capital investment in financial history.
That one bet effectively gave him unlimited resources and confidence to attempt his next, even grander vision, the Vision Fund. We should note, though, that by 2023, SoftBank had sold most of its stake in Alibaba. Was that a strategic move or a necessity?
It was a necessity born of strategy and subsequent losses. Divesting the Alibaba stake piece by piece allowed SoftBank to realize massive cash gains. Those gains were vital for fueling new investments and, critically, covering the monumental losses incurred by the Vision Funds later on.
Right. It was realizing the golden ticket to pay the bills.
That's exactly what it was.
So before the Vision Fund launch in 2017, Sun made a huge foray into the competitive U.S. telecom market with Sprint. Another classic SoftBank move high leverage, massive scale.
Absolutely. Throughout the 2010s, SoftBank bought a controlling share in Sprint, eventually reaching about 84% ownership. The strategic objective was clear: use the financial stability built in Japan to compete at the very top tier of the world's most profitable mobile market.
Trying to challenge Verizon and AT&T.
Exactly. But Sprint struggled to compete effectively.
So how did Sun ultimately resolve that difficult investment?
He resolved it through strategic consolidation, proving his strength as a financial engineer even when the underlying operational performance was lagging. In 2020, Sprint and T-Mobile US merged in an all-shares deal valued at $26 billion. And SoftBank's stake in the combined entity gave them significant assets.
And the final financial maneuvering here is worth detailing. He didn't just cash out of the U.S. market.
No, he executed a really sophisticated swap. SoftBank later sold its resulting stake in the merged T-Mobile US Inc. to Deutsche Telekom AG, which was T-Mobile's parent company, in exchange for acquiring a 4.5% stake in Deutsche Telekom itself.
That was a brilliant move.
It transitioned a difficult, debt-laden operational stake in the U.S. into an anchor holding in a stable, global European telecom giant. It further diversified SoftBank's foundational assets and provided substantial liquidity.
And that liquidity from both the Alibaba divestments and the Sprint consolidation set the stage for the next foundational technology move, the colossal Arm Holdings mega acquisition in 2016.
The acquisition of Arm was a definitive statement that Sun was moving from services and operations into foundational hardware IP. In July 2016, SoftBank acquired UK-based Arm Holdings for about £24 billion, which was around $34 billion at the time.
Which was the largest purchase of a European tech company ever at that point.
It was.
So what made Arm so essential and worth such a staggering price tag?
Arm is foundational. It designs the instruction sets and the architecture that power the vast majority of mobile chips globally, including the ones used by Apple, Qualcomm, and everyone else.
Right.
Sun viewed this IP as the critical hardware key to unlocking the future of the Internet of Things and, crucially, artificial intelligence. He was buying the blueprint for the digital future.
And the ultimate plan was to sell Arm to NVIDIA, but that deal collapsed spectacularly due to regulatory pressure. Can you elaborate on why that $66 billion deal failed?
Well, the deal, initiated in 2020, was intended to create this integrated computing powerhouse that Sun publicly said would lead the era of AI.
Yeah.
However, U.S. and EU antitrust regulators viewed the merger as a massive threat to global competition.
Why?
Arm's business model relies on its neutrality. It licenses its chip designs to everyone. Regulators fear that if NVIDIA, a major chip producer, owned Arm, it would inevitably restrict access to that foundational IP for competitors, stifling innovation and creating an effective monopoly.
So the regulators effectively told Sun that the consolidation he had used so successfully in telecom just wouldn't work when it came to foundational technology IP.
Exactly. The deal collapsed in February 2022. This failure forced Sun to pivot once again, proving that external forces often dictate the outcome of his biggest risks. ARM then subsequently filed for a confidential U.S. stock market listing in 2023.
Trying to establish a valuation on its own.
Right, seeking to raise billions and establish a valuation, estimated somewhere between $30 and $70 billion, independent of a full corporate sale.
This period wasn't only defined by tech and telecom, though. The sources highlight a significant strategic and frankly emotional shift toward renewable energy following the 2011 Fukushima Daiichi nuclear disaster.
This was a deeply personal and political response. Sun was highly visible and vocal, publicly criticizing the nuclear industry for creating what he termed the problem that worries Japanese the most today.
It was a rejection of Japan's established energy infrastructure.
It was. And true to his nature, his solution was not small-scale. It was massive-scale infrastructure investment.
Of course.
He immediately invested in establishing a nationwide solar power network for Japan. But he also took the vision global. In 2018, he announced investment in a planned 200-gigawatt solar project in Saudi Arabia, part of their Vision 2030 efforts.
Wow.
And he promised to underwrite most of a planned 100 gigawatts of new renewable provision in India by 2027. These are nation-building scale projects designed to fundamentally shift global energy sources.
Which brings us to the most defining and most financially volatile chapter of his career, the Vision Fund. In 2017, Vision Fund 1 launched with a staggering target of $100 billion. The sheer scale was just unprecedented.
The magnitude of this vehicle just redefined global venture capital. Sun convinced massive sovereign wealth funds to participate, most notably the Saudi Public Investment Fund and Abu Dhabi's Mubadala, by selling them this dream of monopolizing the future of AI, robotics, and the Internet of Things.
And the scale was the strategy.
Exactly. The scale was designed to give SoftBank unprecedented leverage, enabling them to essentially buy control or massive influence in any company they chose.
And the strategy went beyond just finding good startups. Sun was trying to create an interconnected ecosystem.
He called this intertwined synergies. Sun's goal was to make personal connections with the CEOs of all portfolio companies, which included Coupang, Didi, DoorDash, Grab, Oyo, Paytm, Uber, and WeWork. The idea was that these companies, all funded and guided by SoftBank, would cooperate, share data, and collectively dominate their sectors.
Creating a network effect no one could match.
That was the idea.
That was the peak of the ambition. But the source materials describe this period as an awkward fall from grace, which is a polite way of saying the whole house of cards began to collapse.
The fund's rapid deployment led to critical weaknesses that were dramatically exposed by external shocks, primarily the COVID-19 pandemic, which crushed travel and real estate valuations, and the Chinese regulatory crackdown, which heavily impacted major holdings like Didi.
Let's detail the specific financial turmoil, because this is where the speed and magnitude of the losses become alarming, starting notoriously with WeWork.
The WeWork fiasco became the symbol of the Vision Fund's lack of due diligence and just insane overvaluation. Adam Neumann, the CEO, was given nearly carte blanche funding. When the company tried to IPO, the market just balked.
At the massive losses, the governance.
The whole thing. SoftBank was ultimately forced to execute a massive bailout, resulting in a staggering loss of 700 billion yen.
And WeWork wasn't an isolated incident. The losses included other firms across various sectors, and some involved major governance or even ethical failures.
Correct. The losses were widespread. OneWeb, the satellite company, Katera, construction tech, Greensill Capital, supply chain finance. But perhaps the most damaging to SoftBank's reputation was the investment in Wirecard.
The German payments company.
Yes, which was later exposed as having engaged in massive fraud, including forging client details to secure a hefty 900 million euro SoftBank investment.
The fact that a fraudulent company got into the portfolio raised really serious questions about SoftBank's investment speed and diligence process.
Of course.
How did these losses impact SoftBank's standing in the market overall?
The losses fundamentally changed how the market valued the entire conglomerate. SoftBank Group's own stock began chronically trading far below the actual value of its assets, including the still valuable Alibaba stake.
The dreaded investor discount.
Exactly. It reflected extreme concerns about his risk appetite, past performance, and the structure of the fund. The market was essentially signaling that it was deeply concerned by Son's high enthusiasm for investing vast sums in loss-making companies at eye-popping valuations.
Despite all these struggles, he immediately tried to double down on the strategy with Vision Fund 2, targeting another $108 billion. But the market refused to play ball this time.
Vision Fund 2 had to be significantly scaled down. The initial failure to attract outside capital at the same level as VF1 was a powerful signal of lost external confidence. As a result, SoftBank Group and Masayoshi Son himself had to become the primary investors.
He had to fund it himself.
Son personally committed $38 billion of his own resources in the group's capital.
And faced with these internal capital constraints, Son responded by dramatically accelerating the pace of investment, focusing on volume over size.
This is a classic pattern for Son. When faced with resistance, he pushes harder and faster. By late 2021, he quintupled the number of companies in VF2 in less than 9 months. The operational implication was a steep decline in focused due diligence. The average investment amount per company plummeted from $943 million in VF1 to just $192 million in VF2. It was a shift from megabets to a rapid scattershot strategy.
Just hoping volume would compensate for quality.
Right.
Then came the ultimate reckoning in 2022 when the market correction hit all those overvalued companies.
The financial results were truly catastrophic. For the financial year ending March 2022, SoftBank Vision Fund posted a record consolidated loss of 3.5 trillion yen, a staggering $27.4 billion. The massive valuation bubble in his portfolio just burst.
We had sharp examples of poor timing that illustrate this broader collapse.
Yes. The investment in the Swedish buy now, pay later startup Klarna provides a painful microcosm. Klarna's valuation plunged a staggering 85% in a single year. These poor timings and massive markdowns led to the enormous losses.
This necessitated a rare moment of public admission and humility from Son, a man usually defined by extreme confidence.
In August 2022, he publicly stated that he was embarrassed and ashamed of his performance running the Vision Fund. The subsequent market analysis was brutal. The Wall Street Journal called SoftBank a big loser, and Barron's characterized the fund as a failed experiment.
And beyond the corporate losses, there was a specific, alarming corporate governance issue tied to Son's personal finances, which directly connected his own risk-taking to the company's stability.
This is the most intensely personal illustration of his high-stakes style. By November 2022, Son personally owed SoftBank $4.7 billion.
How?
This debt wasn't a simple loan. It stemmed from side deals, structured often as special-purpose vehicles or LBOs, which he had set up to boost his own compensation by essentially doubling down on his own technology bets.
So he was taking highly leveraged personal bets on companies the Vision Fund was already investing in. To be clear for you listening, why did this create such a corporate governance controversy?
Because the debt amount grew as the investment soured. By February 2023, his total personal debt had swelled to $5.1 billion. This situation just severely blurred the lines between the CEO's personal financial exposure and the health of the conglomerate.
It's a massive conflict of interest.
A huge conflict of interest between his duty to shareholders and his desire to recover his own personal losses.
And the situation was so precarious that he had to put up his SoftBank shares as collateral.
Exactly. By March 2023, over a third of his SoftBank shares were reportedly posted as collateral for margin loans. This just illustrates the extreme pressure he was under. If the SoftBank stock, which had already plummeted, dropped further, he risked losing control of a significant portion of his voting power in the company he founded.
Given the scale of that failure, the personal financial risk, and all the market scrutiny, you might expect a retreat into conservatism, a shift to just managing the existing core assets.
That would be the rational move.
Instead, Son executed a massive, highly focused strategic pivot that returns him to the visionary role he craves.
He took the lessons from the Vision Fund era, that investing broadly in volatile software and services was too risky and lacked discipline. And he decided to focus entirely on the foundational technology that everything else will rely on.
AI, infrastructure, and semiconductors.
Exactly. From 2023 onward, Son publicly declared AI development as the single primary focus of the group's future strategy. It was a radical refocus, moving from a scattergun VC approach to a targeted industrial mission.
This shift required leveraging the crown jewel he still controlled, Arm Holdings, the chip designer.
Arm became central to the new strategy. The goal shifted from simply selling or licensing ARM to using it as the core intellectual property engine for SoftBank's push into AI. Son's vision is now about owning and building the plumbing,
The data centers, the computing capacity,
the semiconductor architecture, all
yeah.
things that power global artificial intelligence.
And the most tangible representation of this highly specific pivot is the announcement of Stargate LLC. This isn't just an investment, it's a joint venture with some of the biggest names in tech.
Stargate LLC is incredibly significant. Announced in January 2025, Sun was named chairman of this new AI infrastructure joint venture. And look at the partners. SoftBank is collaborating directly with OpenAI, the leader in generative AI. Oracle Corporation, a powerhouse in cloud infrastructure, and MGX, the technology investment arm of Abu Dhabi.
That partnership structure is far more structurally sound than the early Vision Fund's reliance on disparate startups. What does each partner bring to Stargate?
Well, OpenAI brings the immense demand for computing power and the leading AI models that need to be trained. Oracle provides the enterprise-level cloud infrastructure and data center expertise. MGX provides significant, stable sovereign capital.
And SoftBank.
And SoftBank, through ARM, provides the essential semiconductor design and strategic foresight needed to build the custom AI chips and facilities. Stargate is about creating a dedicated, controlled ecosystem of AI processing capacity, not just betting on other companies.
And the financial results seem to validate this focused redirection. SoftBank has reported a return to profitability.
Yes. The pivot appears successful, demonstrating that focus and concentration can stabilize the massive swings of the past. SoftBank reported a return to profitability in the 2024-2025 fiscal year. Reuters specifically highlighted the net profit for Q2 FY 2025, which more than doubled to 2.5 trillion yen.
And that was driven by AI.
Directly supported by substantial valuation gains related to his AI-linked technology holdings, particularly ARM and its related ecosystem.
So market analysis is finally moving past the failures of the Vision Fund and endorsing this new direction.
The shift has earned renewed investor trust. Analysts noted that SoftBank's increased emphasis on ARM, massive data centers, and AI-related computing capacity is completely consistent with the strategic direction Sun had outlined. The chaos of the high-speed scattershot Vision Fund era has given way to a highly concentrated, specific strategic commitment to owning the future of AI hardware.
We've thoroughly tracked the monumental swings in his career. Now let's look at the individual behind these decisions. What do we know about the man, his personal life, and his defining traits that help us understand his approach to risk?
He presents as a fascinating and perhaps predictably extravagant blend of the high-powered executive and the private enthusiast. He met his wife, Masami Ono, while both were students at UC Berkeley.
She was the daughter of a prominent Japanese doctor.
Right. They married in 1979 and have 2 daughters.
And his taste for luxury reflects the monumental scale of his financial risk-taking. I mean, it is a lifestyle that demands his continued success.
Absolutely. The details of his homes are extraordinary. He lives in an $85 million 3-story mansion in Tokyo, but the defining feature is the customization.
The golf range.
The highly sophisticated golf range capable of mimicking the exact weather conditions, temperature, and even wind speeds of the world's top golf courses, from Augusta to St. Andrews. He also owns a vast home near Silicon Valley in Woodside, California, which cost $117 million. This is a level of wealth that demands constant, successful maneuvering.
He also maintains ties to traditional Japanese culture alongside his global high-tech interests. He owns the SoftBank Hawks, a professional Japanese baseball team.
And the entrepreneurial drive is clearly a family trait. His youngest brother, Taizo Son, is a serial entrepreneur and investor himself. He founded Gung Ho Online Entertainment and the VC firm Mistletoe. The whole family operates within that high-stakes world of tech and finance.
And for the fine details, the sources note his appreciation for Burgundy wine, specifically La Tâche by Domaine de la Romanée-Conti.
Okay.
It's those specific luxuries that ground the giant in a particular definition of success.
What truly brings us full circle, however, is his own assessment of his professional outlook, directly linking his identity and his personal risk profile. In an interview, Son stated that had he stayed his entire life in Japan, he probably would have become much more conservative, just as other Japanese.
That quote is the analytical key, isn't it? It synthesizes everything we discussed about the pressure of his Zainichi identity and the advice of Den Fujita.
It explicitly connects his extraordinary global risk appetite to 2 formative choices: his early relocation to the United States at age 16, and his subsequent decision to defiantly use his Korean surname. He is arguing that his business aggressiveness is not merely a strategy, it's an extension of that personal defiance.
So, by rejecting the expected conservative path.
He defined his entire career by embracing risk as a necessary component of his success and validation. The failure of the Vision Fund, while financially devastating, can be viewed not as a deviation, but as an extreme amplification of the high-leverage, rapid-scaling modus operandi he perfected back in his student days at Berkeley.
Okay, let's summarize the key takeaways from this journey into Masayoshi Son's life. We have witnessed a career defined by extreme volatility and profound psychological pressure. From being a self-made student millionaire, enduring suicidal thoughts due to discrimination, becoming the person who lost $59 billion, and now, finally, re-emerging as a central AI infrastructure visionary.
The entrepreneurial conviction necessary for this journey is truly rare. His survival was anchored by the foundational success of Alibaba. That $20 million stake was the strategic reserve that allowed him to make massive operational pivots in telecom when the dot-com crash wiped out his capital.
It was the wellspring.
It was the wellspring that later funded the trillion-dollar ambition of the Vision Fund.
The entrepreneurial lesson here is both inspirational and, frankly, terrifying. Son's journey demonstrates that visionary conviction sometimes requires absorbing monumental, history-making losses. The $5.1 billion personal debt, the shame of the Vision Fund collapse, to achieve global influence and drive industry pivots.
He refuses to simply manage capital.
Right. He insists on shaping the architecture of the future.
And that shapes our final provocative thought for you, the listener. We saw how Son sought intertwined synergies among his Vision Fund companies, a massive, complex, and highly interdependent portfolio that ultimately failed due to governance issues, speed, and external shocks. Now he has executed a dramatic pivot, chairing Stargate LLC, working directly with powerful and highly structured partners like OpenAI, Oracle, and MGX to build critical AI infrastructure.
This new ecosystem, focused on owning the plumbing of AI, is arguably even more systemically critical than the one the Vision Fund attempted to build.
It is. So how might his earlier failures with that massive interdependent investment vehicle inform how he designs interdependence and minimizes systemic risk in this new, critical, AI-focused ecosystem?
That's the question.
Will the hard lessons of WeWork's governance failure and Wirecard's fraud force him to build a fundamentally more resilient, structurally sound, and cautious network this time? Or will the thrill of the mega bet on AI infrastructure outweigh caution and discipline once again? That's the question that will define his next decade as a global risk-taker.